Friday, May 30th, 2025. Days, happy times to you. I am bringing you the market news about Bitcoin and crypto, and I'm here to share with you why it probably had a very nice move to the downside. In fact, it's not probably, we saw it coming, and I told you about it days ago, didn't I? Remember, I told you on the weekly time frame of Bitcoin, for example, to look at the APPs, and as we saw it starting to come down, it was kind of obvious that there was a very high probability that the price action would follow, not because the APPs are the leading information, but because they are the confirmation information, right? The secondary indicators. They work hand in hand with the leading primary indicators that also indicated a move to the downside. And APP confirmed that very nicely. If you look at the weekly, if you drill down to the daily, and if you drill down to other time frames, you'll see very nicely exactly when this drop from the top started after last week's all-time high and this week's beginning to dip. By the way, for people who are looking for historical patterns, it's a waste of time. You'll notice last year, I also mentioned during the Bitcoin 2024 conference that happened in July, I said, y'all who are expecting the price to go to the moon because Trump is going to talk at this event, probably not going to happen. And it did not happen. And same thing when he had that conference at the White House. Price did not go to the moon, even though it is a huge deal that there is even an executive order, forget an actual legislatively passed act or anything, but even the fact that there's an executive order that says the government will actually have these reserves, right? It's actually, technically speaking, a very big deal for the crypto space. But that's not a reason for price to go sky high, because news events don't dictate volatility, entropy, probabilities, or statistics. Now, you might say that they do, but they don't. And you can point to things like, well, when the tariffs happened, the price dropped immediately, and then they bounced as soon as he's paused them. No, the moves were in motion ahead of his announcements. You can say that people exacerbated the moves by panic selling. Right? So some percentage of the market panic sold, and the bots just, were operating anyway on what they were seeing. And they were saying, yeah, there's more sell pressure. We're going to, dump it out. And when it bottoms, we're gonna long it. And most people were selling at the bottom, right? But the bots were dumping out from the top, not because of the policies that were announced, right? The panic was after the prices started to dump, right? The price doesn't dump. There isn't panic before the price dumps. The panic is once the price is already falling and everybody sees it is falling, then they freak out. Why? Because somebody sells a bunch of it. That triggers a panic, right? Well, who sold a bunch of it? Well, the bots. Why do they sell a bunch of it? Because the assets were a mean reversion. Nothing to do with the policies, okay? Now, you could say, well, how you can't prove that. It's too well timed. No, there's always market forces at play that are beyond just the maths. No, there really aren't. And I can prove it to you. Because how many hours a day do you think the high frequency trading bots that run most of the trades, how often do you think they're reading newspapers and watching the news and consuming consumer news? How often do you think that happens? Right? If the answer is zero, you might be correct. But it's not zero. It's less than zero. They don't watch the news. They don't read the news. They don't listen to podcasts about business and the markets. Right? They just trade. They're bots built to trade. And you can say, well, there are bots that interpret the news and they're designed that way. Yeah. And how are those bots doing? Right? People have tried forever to make bots that read supposed market sentiment and read the news and do all this evaluation stuff instead of just doing the math, which is all you need. And yeah, I know, doing the math isn't always as fun or as sexy as just interpreting a story, having a narrative. But what moves the markets is the maths. It's not the stories and the narratives, right? What sells the market or the concept of the market to people who aren't in it yet, what gets people excited to join a market, or what gets people interested in watching what happens in a market, but still sit out on the sidelines. And like when the market goes up, they cheer, and when the market goes down, they're like, "Oh, that's sad." But it doesn't actually affect them because they don't actually have any interest invested in the market. Okay, the only way it affects them is the broader economy might affect them in some sense, depending on how much prices go up or down. But it doesn't matter if Intel's price goes up and you don't own any share of Intel. It doesn't matter if Nvidia's price goes down, you don't have any Nvidia. It doesn't matter if Bitcoin's price goes to $100 million, you don't have any Bitcoin. You know what I'm saying? So what moves the market is maths, not narratives, and not events, not news. Okay, it's just maths. We saw it again at the Bitcoin 2025 conference this week. Right? People were expecting, oh wow, Bitcoin in Las Vegas, it's going to be huge. We just had an all-time high. Let's go to the moon. No, we just had an all-time high. The ass has been running up for about 8 weeks. Right? It's very much due for a little mean reversion, and that's exactly what happened. Right? We had that mean reversion happen on a bunch of different time frames. And by the way, it's not necessarily done. Like it's barely come down. Right? It went from like 110 or 111, whatever, almost 112. To like 104 and change, like not even 10%, which in this world is minuscule, right? And that's really not a lot in the world. Itty bitty Bitcoin, right? Whatever the dump I was out to last night. I mean, 103, 104, something like that. I don't know. I forgot to look at the exact number. I just saw it dump down nicely. By the way, if you look at where it dumped out nicely too, like pretty much exactly to from what I saw, it was like a 4-hour Laplace distribution band to the downside. I forget it was the 95.5. I think it was the 95.5, but it might have been 68.3 since it was dumping for hours and hours before that already. So, once again, the VEPS indicators showed you the way. Right? Days before it happened, you had every opportunity to get into shorts and take profit on that dump. Now, does it look like it's going to keep dumping today? Well, if you look at the VEPS on the daily candle from what I saw in Bitcoin today, I mean, even though the candle was going to the upside, the candle is the least thing we look at. Right? It's the least important thing. Right? We look at the leading indicators first. From what I saw, it still has significant potential to the downside, but it is the last traditional trading day of the month. Right? Because tomorrow's the 31st. It's a Saturday. And then the new month starts on a Sunday. And the new week starts on the 2nd of June on a Monday. So keep that in mind. So basically, it is the last trading day of the month. We know a lot of people like to do on the last trading day of the month. Either they like to take profit, very, very typically, right? Or, some people might feel their oats and be like, yeah, let's go for, swing and a miss or a swing and a hit. See what kind of luck they have. But typically speaking, it's kind of obvious what happens on Fridays at this point. I shouldn't have to say it. But traditional traders and institutional traders typically don't like to leave positions open running over the weekend, right? So they're going to close their positions, which means you know what's going to happen. Because they're going to sell their position if they're long. Someone's going to buy it to close their position up for them. And they're going to buy the position if they're short, right? Someone's going to sell to them. There's always a buy and a sell in each trade. And depending on which way the price is going, based on the returns that it's following, will determine which way the pressure is going, right? Because you got to remember, the volatility determines the returns, determines the price. Yes, price is random most of the time, right? But if price does anything, actually, apart from being random or occasionally being in a trending move, right? If price does anything, it's really entropy is random or in a trending move. But if price action does anything, because it, apart from being random, what does it do? It follows the returns. Does it follow it every single candle? No. But does it follow the vast majority of the candles? Yeah, it does. And when it falls out of step with the returns, it quickly falls back in line with the returns. So that's why it's so important to know what's happening with the returns, just like it is with the volatility or the variance or the entropy. Right? Those are the key indicators to know and to master. And yes, there are other key indicators like the RMLR and the AT-Wolf forecast, which shows you the distribution model looking into the future, and the UPM, power means, and VLMA lines, the variance log MA lines, and a whole bunch of other tools that we have at Alpha Trading, which you can learn to use for free. You can get free access, by the way, to the Alpha Trading Volatility Starter Pack. You just go to alphatradinghq.com/discord. And there's a channel there called Request Support. When you go into the Request Support channel, there's a little button there that says Create Ticket. And you click that ticket, Create Ticket button. It opens up a ticket. And in that ticket, you literally just write that you want your free access to the Volatility Starter Pack. And once you request your Volatility Starter Pack free access, just type in your TradingView username along with that request. So I want my free access to the Volatility Starter Pack. My TradingView username is whatever. Write that, and then your request will get handled. You'll get your access to the tools, and off you go to the races with volatility and probabilities and statistics. Right? Try it. It's free. No reason not to. You can certainly try it. Like, you can learn. You can trade for free using virtual servers or just practice trade. Doesn't matter. Practice trade with a piece of paper. Like, write down your entry price and write down your exit price. Doesn't matter, right? Just look at the screen. Put a vertical line in, where your entry would be, where your exit would be. Okay. And then, or horizontal or whatever kind of line you want to put in. Circle it with a pen tool. It doesn't matter. All right, just mark it somehow so you see, and then you can measure your profit. But the easiest thing to do is usually to just use a virtual server from one of the exchanges. You can even use, by the way, on TradingView, they also have virtual trading where you can practice there too. And if you practice there too, you also have they give you some amount of dollars, virtual, some fake dollars to practice with, just like they do on, if you use, I think Binance or Bybit or any number of different exchanges has these virtual servers you can use to practice trading. What you want to make sure is that you're using a real-time chart that matches what's on the virtual server, because a lot of times the virtual server, there might be some delay in what's happening. So you want to make sure you're using on the virtual server, you're trading an asset that has a real-time chart. And the way you do that is you compare what you see on the virtual server with what you see on the charts. And an easy way to do that is to look at super low time frames and see how the price is moving. If the price is moving identically to what's happening on the virtual server as it is on TradingView on your chart, then it's the same price. It's the same chart. If there's a delay or they're different prices completely, then you're not on the same chart. And and it also makes it easy for you to. It makes it easier for you if you're going to do that. If you can't find a synchronized chart to practice with, then you can just use a higher time frame on a chart that's on the official chart from that exchange. So if you're trading Bitcoin USDT perpetuals or whatever, just use that chart and use a higher time frame, like a 15-minute or something, so you can see, generally speaking, fairly easily how it's going. But it's best to use, honestly, the same chart if you at all can, or just like I said, don't even use the virtual server. If you already know how to use exchanges, just use the regular chart look at the regular server, but don't actually run trades, right? Just mark the trade where you would enter and where you would exit, and just watch it. And if it goes against you, where you would get out. You need to know where you would get out because you need to get out, right? If you're losing, if you're winning the trade, obviously you want to stay in, optimize your profit, and then get out. But you don't want to wait for your returns to decay, right? Because that'll when the assets distribute, the next thing you're going to do is mean revert. Well, if they mean revert against you, then they're going to eat away at the profits you made. So don't let it do that. It's much better to just get in, see it go in profit, and before it starts mean reverting, just take your profit. Even if it continues going in that direction, it doesn't matter that you lost. You didn't lose. That you didn't take that extra 0.5% or 2% or whatever. It doesn't matter. It matters that you got out with profit, right? That's the most important thing, right? Because you can always enter a new trade. That matters more than did I get the maximum for every trade. Statistically, it's impossible for you to get the maximum for every trade. It's just not even. It's the amount of trading you're going to do is negligible compared to the market, right? You're not even a data point. Your entire trading career is barely a blip on the market. If you trade 40 years of your life, okay, and you trade like 8 hours a day, 5 days a week, your entire trading career will be a blip on the charts, right? So just remember that. Even if you work in an HFT firm or a quant shop, the amount of trading you'll do, right? Yeah, compared to an average person, will be massive in terms of the amount of trades you'll run. But compared to the overall market, no one person is running most trades on the market, right? It's thousands of traders at top firms around the world. So yeah, it may be less negligible, but still a very small data point in the overall scheme of things. Nowhere near 1%, unless you, for some reason, are like the kingmaker of all, the top markets or something, which not likely. And so that's my little message for you. All right, Bitcoin dropped because of the VEPs and the APP showed you ahead of time that it was likely to happen, and it happened exactly as I told you. You shouldn't be surprised by that. You should just be happy that you have access to that information. And if you're smart, you should be using that access to that information. And, making the most of it because, well, it's useful information for market traders. Okay, I think that's going to do it for now, folks. Hope you all have a wonderful day. Everyone, life gives you lemons. Give them to people. A little stack here of lemons I give to people.